Hey there! In our last video, we covered the basics of demand and supply and how they come together to determine market equilibrium. We also explored important concepts like consumer and producer surplus. But now, we are going to delve into a concept that's essential for understanding how markets really behave: elasticity. What's elasticity? Well, in a general sense, it just means responsiveness or sensitivity. Elasticity in economics is very similar. It measures how much one thing changes in response to another. For example, if the price of your favorite video game goes up, will you still buy it? Or will you look for something cheaper? That responsiveness to price change is what we are measuring with elasticity. We'll be focusing on how sensitive buyers and sellers are to changes in price, something economists call price elasticity. This concept has huge implications for how different market policies actually work in the real world. It affects everything from taxes to minimum wage. So what's on the agenda for this session? We'll start by building a solid foundation on elasticity first, making sure you really understand what it means and how it applies to both demand and supply. But we won't stop there. We're going to take that knowledge and use it to analyze real-world microeconomic policies. Think taxes, subsidies, tariffs, the whole shebang. We'll see how elasticity can help us predict how these policies will impact markets, consumers, and producers. And finally, we'll wrap things up with a fascinating look at how consumers make choices to maximize their satisfaction. Because, let's face it, who doesn't want to get the most bang for their buck? Okay, so let's get down to business and talk about elasticity. What is it exactly? Well, at its core, it's all about responsiveness. Think of it like a rubber band. You know how some rubber bands stretch really easily with just a little bit of force? Those are like elastic situations. But then you have those stubborn rubber bands that are super hard to stretch, right? Those are inelastic. Now take a look at these two graphs. See how different those slopes are. And remember, the scales of both graphs are exactly the same. So a steeper line, like the one on the left, means that a small change in x causes a really big change in y. That's what we call elastic. Okay? But on the other graph, shown on the right, we have a much flatter line. What does that tell us? A change in x only leads to a very tiny change in y. That's inelastic. Now, why do we care about this in economics? Well, we use elasticity to figure out how much buyers and sellers change their behavior when things change, like prices or incomes. It's like having a crystal ball that helps us predict how people will react to different policies or events. Alright, let's dive in and explore price elasticity of demand first. Now that might sound like a mouthful, but it's actually a pretty straightforward concept. Essentially, it measures how much the quantity demanded of something changes when its price changes. Think of it this way. The price of your favorite chocolate bar suddenly doubled. Would you still buy the same amount? Probably not, right? You might buy less or maybe even switch to a different candy altogether. That's exactly what price elasticity of demand helps us understand. Now here's a little trick to remember. Price elasticity of demand, or PED for short, it's almost always negative. Why is that? Because as the price goes up, the quantity demanded usually goes down. They move in opposite directions like two kids on a seesaw. But here's the kicker. It's not just about whether the number is positive or negative. It's about how big that number really is. That's what tells us the real story. So what makes demand for something more or less elastic? Well, think about it. If there are tons of similar products out there, demand tends to be more elastic. Why? Because if the price of one goes up, you can easily switch to another, right? But what about things like, say, life-saving medication? Those are necessities. We need them no matter what, even if the price goes up. That's what we call inelastic demand. And here's another thing to consider. How much of your income does something like that take up? If it's a big chunk, you're going to be way more sensitive to price changes, wouldn't you? Finally, remember that time matters. In the short run, you may not have many options, but over time, you can adjust your habits, find alternatives, and become less dependent on a particular product. Now that we have a solid understanding of what price elasticity of demand is, let's move on to the methods for calculating it. We'll begin with the 2-point formula. This formula provides a straightforward way to understand elasticity by comparing the percentage change in price with the corresponding percentage change in quantity demanded. However, when dealing with larger price fluctuations, a more precise measurement may be necessary. In such cases, we can utilize the midpoint formula. The formula uses the average price and average quantity as reference points, leading to a more accurate calculation. As you can see, the formulas include the delta symbol, right, which in mathematics simply represents change in something. Therefore, delta Q represents change in quantity and delta P represents a change in price. These changes are calculated by subtracting the initial values from the final values. For those of you who are familiar with calculus, it's worth noting that derivatives can be used to determine the precise price elasticity of demand at a specific point on the curve. Think of the ratio delta Q by delta P as representing the slope of a tiny section of the demand curve. As those changes get infinitesimally small, it becomes the derivative. Because dP by dQ is the slope of this line, dQ by dP becomes the inverse of the slope. While a deep understanding of calculus may not be essential for everyone, the key takeaway is that we have various tools at our disposal to measure how sensitive consumers are to changes in price. This knowledge is crucial for comprehending market dynamics. Let's now turn our attention to the table and chart presented on this slide. As we move along the demand curve, observe how the price elasticity of demand varies. You'll notice a critical point where the elasticity equals 1. This point is referred to as unit elastic. When the price elasticity of demand, or PED, exceeds 1, we say demand is elastic. This implies that a change in price results in a proportionally larger change in quantity demanded. Consequently, if we reduce the price in the elastic region, total revenue will actually increase because consumers are highly responsive to price adjustments. Conversely, when the PED is less than 1, demand is considered inelastic. In this scenario, a price change leads to a proportionally smaller change in quantity demanded. Therefore, decreasing the price in the inelastic region would result in a decrease in total revenue. At the point of unit elasticity, where PED equals 1, changes in price and quantity demanded perfectly offset each other, leaving total revenue unchanged. A thorough understanding of how elasticity changes along the demand curve is essential for businesses to make informed pricing decisions that optimize revenue. Let's delve a bit deeper into this fascinating relationship between price elasticity of demand and a company's total revenue. Take a look at this table and chart which is on your screen right now. What do you notice about the highest point on the total revenue curve? It corresponds to the point of unit elasticity where the price elasticity of demand, or PED, is equal to 1. Now, why do you think that is? Well, in the region where demand is elastic, we saw that where PED is greater than 1, a decrease in price leads to a more than proportionally increase in quantity demanded. This makes sense, right? If something becomes more affordable, people tend to buy more of it. And what happens to total revenue in this case? It goes up. But here's where things get interesting. When demand is inelastic, or when PED is less than 1, a price reduction actually leads to a less than proportionate increase in quantity demanded. So what do you think happens to total revenue then? It goes down. And at that sweet spot of unit elasticity where PED equals 1, price changes and changes in quantity demanded perfectly balance each other out. This is where total revenue reaches its peak. This analysis really highlights how important it is to understand the interplay between price elasticity and total revenue. It shows us that simply raising prices doesn't always lead to more money in the bank, right? We need to consider how our customers will react to those price changes. Okay, so we've spent a good chunk of time talking about how prices affect demand. But what about another major factor, income? That's where income elasticity of demand, or YED for short, comes into play. Essentially, YED tells us how changes in a consumer's income affect how much they buy of a particular good or service. The formula is pretty straightforward. It's just the percentage change in quantity demanded divided by the percentage change in income. Simple enough, right? But here's where it gets interesting. The sign, positive or negative, of that YED value tells us a lot. A positive YED means that we are dealing with a normal good. Think about it. As your income increases, you probably buy more of certain things like restaurant meals, new clothes, or maybe even a fancy vacation. These are normal goods. But what about a negative YED? That's a signal that we are looking at an inferior good. What does that mean? Well, as your income goes up, you actually buy less of these type of goods. Can you think of any examples maybe? Maybe generic brand products or used goods, for example. When we have more money to spend, we often trade those in for higher quality options. So why should businesses care about income elasticity of demand? Well, it's like having a sneak peek into the future, right? It helps them predict how changes in the overall economy might impact the demand for their products. If a company knows that their product is an inferior good, they might want to adjust their strategy during an economic boom, right? And vice versa. Okay, so we've talked about how prices and incomes affect demand, but what about the prices of other goods? That's where cross price elasticity of demand, or XED, comes in. It might sound a bit complicated, but it's actually very intuitive. Essentially, XED measures how a change in price of one good affects the quantity demanded of another good. Think about it. If the price of your favorite coffee suddenly doubled, would you maybe start drinking more tea? That's cross price elasticity in action. The formula is similar to what we've seen before. It's the percentage change in quantity demanded of one good divided by the percentage change in the price of the other good. Now here's the key. The sign of that XED value tells us whether these two goods are friends or foes, so to speak. A positive XED means that we are dealing with substitutes. These are goods that can easily replace each other, like Coke and Pepsi, or iPhones and Android phones. Maybe you're one of those weirdos who doesn't think these are substitutes. Nevertheless, if the price of one goes up, people might switch to the other, right? On the other hand, a negative XED indicates complements. These are goods that tend to go together, like peanut butter and jelly, or cars and gasoline. If the price of one goes up, the demand for the other might go down. So why should businesses care about this? Well, imagine you're a company selling coffee. Wouldn't you want to know how a change in the price of tea might affect your sales? XED can help you anticipate those changes and make smart decisions about your own pricing or even product bundles. Maybe you start offering a coffee and tea combo deal. The possibilities are endless. Alright, we've explored the demand side of the equation pretty thoroughly. Now let's shift gears and talk about supply. Specifically, price elasticity of supply, or PES. Okay, what does PES tell us? Well, it measures how sensitive producers are to changes in price. Imagine the price of a popular toy suddenly skyrockets. How quickly can toy manufacturers ramp up production to take advantage of that higher price? That's what PES helps us understand. The formula is pretty familiar by now. It's just the percentage change in quantity supplied divided by the percentage change in price. But here's a crucial factor that influences PES. Time. Think about it. In the short term, a company might not be able to increase production very easily, even if the price goes way up. Why is that? Well, they might have limited factory space or it might take time to get more raw materials. This means that in the short run, the supply curve tends to be relatively inelastic. However, in the long run, things are different. Companies have more time to adjust, they can build new factories, hire more workers, or find new suppliers. This flexibility means that in the long run, the price elasticity of supply tends to be higher. So why is it important to understand both short-run and long-run PES? Well, it helps us predict how markets will react to different situations. For example, if there is a sudden increase in demand for a product, knowing the PES can help us understand how quickly producers will be able to respond and how that will affect the price. It also helps us analyze the impact of policies that might affect prices like taxes or subsidies. Okay, so we've explored a lot of ground covering the fundamentals of supply and demand. But how does the government fit into all of this? Well, get ready to put on your policy making hats because we are about to dive into the world of government intervention. Governments have a whole toolbox of policies they can use to influence markets. We can broadly divide these into two categories: microeconomic and macroeconomic policies. Microeconomic policies are like precision tools. They target specific markets or industries. Think of things like rent control, which aims to make housing more affordable, or minimum wage laws, which try to ensure fair wages for workers. Or what about subsidies for renewable energy? That's a microeconomic policy designed to encourage the use of clean energy sources. On the other hand, we have macroeconomic policies. These are more like broad brush strokes that affect the overall economy. Think of tariffs and quotas and imports, which can protect domestic industries but also potentially raise prices for consumers. Now here's the thing, while these policies often have good intentions, they can sometimes have very unintended consequences. For example, a price ceiling might lead to shortages, or a subsidy might distort market signals. It's a bit like a game of economic chess. You have to think several moves ahead. In the following slides, we'll take a closer look at each of these policies. We'll examine how they shift those supply and demand curves we've become so familiar with and how they ultimately affect market equilibrium. First, let's dive into the world of price ceilings. Now, what exactly is a price ceiling? It's simply a legal limit on how high the price of a good or service can go. Sounds like a good idea in theory, right? Especially if you're trying to make things more affordable for consumers. But here's the catch: price ceilings can sometimes backfire and have unintended consequences. Let's take a look at these graphs to see why. The first graph shows a typical supply and demand diagram. Remember those consumer and producer surplus areas we talked about earlier in the previous session? This is a free market, so everything's humming along really nicely, right? But look at the second graph. The government has stepped in and imposed a price ceiling, a maximum price that's actually below the natural equilibrium price. What happens here? Well, at that artificially low price, suddenly everyone wants to buy that good or service, okay? But producers aren't willing to supply as much at that lower price. What do we end up with? A shortage, okay? Some consumers who would happily pay the market price are left out in the cold, okay? And that's not all. See that shaded area in gray here? That represents deadweight loss. It's basically the value that's lost to both consumers and producers because of this market inefficiency. So while price ceilings might seem like a well-intentioned way to help consumers, they can actually end up hurting the market as a whole. It's a classic example of how good intentions don't always lead to the desired outcomes. Okay, so we've seen how price ceilings can cause problems. But what about when the government tries to set a minimum price for something? That's where price floors come in. Essentially, a price floor is a legal limit on how low the price of a good or service can go. A classical example here is minimum wage laws, which aim to protect workers by ensuring they can earn a certain minimum hourly wage. Now let's take a look at the graphs on your screen here. Okay, the first graph, we are familiar with that already. Okay, But in the second graph, the government has imposed a price floor, okay, a minimum price that's above the natural equilibrium price. What happens then? Well, at that artificially high price, producers are eager to supply a lot of that good or service, okay? But consumers aren't so keen to buy it at that higher price, okay? As a result, we have a surplus of goods here. We end up with more of that good or service than people actually want to buy. And just like with price ceilings, we see that pesky deadweight loss again. Okay, that gray shaded area represents the value that's lost to both consumers and producers because of this market inefficiency. So while price floors might seem like a good way to support producers, they can also lead to surpluses, potential waste, and a less efficient market. It's a reminder that even well-intentioned policies can have unintended consequences. Policymakers really need to weigh the pros and cons of this carefully. Alright, let's talk taxes. We all know taxes are a part of life, but have you ever stopped to think about how they actually affect markets? Well, let's break it down. Take a look at this graph. Notice how adding a tax causes the supply curve to shift upwards. Why is that? Well, sellers now need to receive a higher price to cover the cost of that tax. Makes sense, right? Now, let's dissect this graph a bit further. We can see several different areas here, right? Okay. The yellow area represents the tax revenue that the government collects. It's basically the difference between what the consumers pay and what the producers receive, and that's multiplied by the quantity sold at this new equilibrium. But taxes also affect consumer and producer surplus. The blue area, as always, shows consumer surplus, and you can see that it shrinks after the tax is imposed. The same goes for producer surplus, shown here in red. Both consumers and producers end up with less surplus than they had before. And finally, we have that gray area which represents deadweight loss. It's the overall loss of surplus due to the tax. Essentially, it's the inefficiency caused by the tax because it reduces the quantity exchanged in the market. So taxes can have a significant impact on market outcomes. They generate revenue for the government, but they also affect the consumer and producer surplus and can lead to deadweight loss. It's a very delicate balancing act for policymakers. Okay, so we've seen how taxes can affect markets, but here's a really important question. Who actually ends up footing the bill for those taxes? Is it the consumers or the producers? Well, the answer isn't always straightforward. It actually depends on how sensitive consumers and producers are to price changes. In other words, their elasticities. Let's dive into these two graphs to see this in action. In the first graph, we have a situation where the demand is relatively inelastic. Remember what that means? Consumers aren't very responsive to price changes. So when a tax is imposed, guess what? Consumers end up paying most of the tax, shown here in yellow. Okay? Now look at the second graph. Here the demand is much more elastic. Consumers are very sensitive to price changes and they can easily switch to other products if the price gets too high. In this case, producers are forced to absorb a large portion of this tax burden, shown here in green. They can't simply pass the entire tax on to consumers because consumers will just take their business elsewhere. This relationship between elasticity and tax burden is really crucial to understand, and it has big implications for policymakers who design tax systems. And it's also important for businesses who need to anticipate how taxes might affect their bottom line. So the next time you hear about a new tax being proposed, remember this: who ultimately pays for it depends a lot on those elasticities of supply and demand. It's like a game of economic tug of war, and the strength of each side determines who wins eventually. Okay, so we've seen how taxes can shift supply curves upwards, but what about when the government wants to encourage production of a particular good or service? That's where subsidies come in. Essentially, a subsidy is like a reverse tax. It's a payment from the government to the producers, which effectively lowers their costs. Think of it as a little financial boost to help them produce more of something. Now let's see how this plays out in the market. Take a look at this graph. see how the subsidy causes the supply curve to shift downwards. Why is that? Because producers are now facing lower costs, so they are willing to supply more at any given price. And what happens to consumers? Well, they're happy too, because the lower cost for producers translates into lower prices for consumers, and they also get to enjoy a greater quantity of the good or service. See how the consumer surplus area has expanded? That's a win for consumers. So subsidies can be a powerful tool for governments to encourage production and make goods more affordable for consumers. But as with any policy, there are potential downsides and trade-offs to consider here. We'll explore those in the coming slides. Okay, so we've seen how consumers benefit from subsidies. But what about the producers? Do they get anything out of this deal? Absolutely, right? Let's take a closer look at the producer surplus on this graph. Remember, producer surplus is the difference between the price producers receive and the minimum price they are willing to accept. Now here's where it gets interesting. Notice how the shaded area representing producer surplus has expanded. Why is that? Well, it's because producers are getting a double benefit from the subsidy. First, they get to sell a large quantity of their goods or services because the subsidy has lowered the market price, making their products more attractive to consumers. And second, they receive that extra payment from the government on top of the market price. It's like a bonus that helps offset their costs and makes production even more profitable. So subsidies not only benefit consumers by lowering prices, but they also give producers a very nice boost. It's a win-win situation, at least for those directly involved in the market. However, it's important to remember the subsidies aren't free money. They come from government funds, which ultimately means taxpayers are footing this bill. So there are always trade-offs to consider. We'll explore those now in more detail. Okay? We've seen how subsidies benefit both consumers and producers, but those benefits come at a cost, right? Someone is always paying for these subsidies. And that someone is usually the government, which means ultimately the taxpayers. Let's take a closer look at this graph now to see how that cost is represented. See that highlighted yellow rectangle? That's the visual representation of the government's expenditure on the subsidy. Okay? How do we calculate that cost? Well, it's basically the difference between what the producers receive, including the subsidy, and what the consumers pay, and that is multiplied by the equilibrium quantity. It's like calculating the total amount of those extra payments the government is making to the producers. So while subsidies can have a positive effect on the market, it's important to remember that they do come with a price tag. Governments have to carefully weigh those costs against the potential benefits when deciding whether to implement a subsidy program. It's all about finding that balance between supporting certain industries or activities and managing public funds responsibly. Okay, so we've talked about how subsidies create winners in the market. Consumers get lower prices, producers get higher profits. But who pays for all this? And is there a hidden cost to these benefits? Well, let's do a little visual accounting here. Take a look at this graph. The blue area represents the extra consumer surplus created by the subsidy. Consumers are definitely better off. And the red area shows the extra producer surplus. Producers are happy too. But remember, those benefits don't just magically appear. The government has to pay for them, and that cost is represented by the yellow area. Now here's where it gets interesting. If we add up the blue and the red areas, which are the gains to consumers and producers, and then subtract the yellow area, the government costs, what are we left with? That gray triangle. That is the deadweight loss, as we've seen in earlier cases too, right? It's the unavoidable cost of the subsidy, a loss of overall surplus that nobody captures. Why does this happen? Well, the subsidy distorts market signals and can lead to overproduction. Resources that could have been used more efficiently elsewhere are being drawn into this market because of this artificial incentive created by the subsidy. So while subsidies can be tempting tools to boost certain industries or activities, they're not without their drawbacks. It's crucial to weigh those costs and inefficiencies against the potential benefits before diving headfirst into a subsidy program. Alright, so far we've been focusing on how things work within a single country's market, right? But what happens when we open the doors to international trade? Specifically, what happens when we allow imports? Okay, well, often we can get goods from other countries at a lower price than it costs to produce them domestically. This is due to various factors like lower labor costs, different resource availability, or economies of scale. Now let's see how this plays out in our supply and demand graphs. Notice how the lower import price puts downward pressure on the overall market price, and what happens as a result? Well, domestic producers find it hard to compete with those cheaper imports. Their production decreases, which creates a shortage in the domestic market. And here's the key. That shortage is filled by those very same imports. Consumers get to enjoy the lower prices and they can buy more of the good than they could have before. Of course, this might not be great news for all domestic producers. Some might struggle to compete and might even have to shut down. But overall, consumer surplus tends to increase when imports are allowed. It's like having access to a wider variety of goods at more affordable prices. So while there might be some losers in this scenario, there are also clear winners. And that's often the case with international trade. It creates opportunities for both consumers and producers, but it can also lead to some adjustments and shifts in the market. Okay, so we've seen how allowing free trade with imports can affect a market. But what if the government decides to step in and protect domestic producers from those cheaper imports? That's where tariffs come into play. Essentially, a tariff is like a tax on imported goods. It raises the price of those imports, making them less competitive with domestically produced goods. Let's see how this looks on our graph. Notice how the tariff pushes the equilibrium price upwards. This is good news for domestic producers. They can now sell their goods at a higher price and compete more effectively with those imports. See how their producer surplus has expanded. But as you might expect, there is a flip side to this coin. Consumers now have to pay more for those goods. Their consumer surplus shrinks as a result. And then there's the government. That yellow rectangle highlights the tax revenue they collect from the tariff. So the government benefits as well. But hold on, what about those gray triangles? Those represent deadweight losses, a loss of overall surplus due to the inefficiencies created by the tariff. It's a bit like a cost of government intervention. So while tariffs might seem like a good way to protect domestic industries and generate government revenue, they often come at a cost to consumers and overall market efficiency. It's a trade-off that policymakers have to really carefully consider. Alright, we just talked about tariffs. Now let's explore another way governments can restrict imports, that is quotas. What's the difference here? Well, while a tariff is like a tax on imports, a quota simply sets a strict limit on the quantity of a good that can be imported. It's like saying, okay, you can only bring in this much of this product and no more. Okay, now take a look at this graph again. Similar to a tariff, a quota also raises the domestic price of the good. Why is that? Because by limiting the supply of imports, it creates some scarcity in the market. And just like with the tariff, this leads to a higher producer surplus for domestic producers. They get to sell more of the goods at higher price. But unfortunately for consumers, it also means a smaller consumer surplus as they face those higher prices. But here's the key difference between a quota and a tariff. The government doesn't collect any tax revenue with a quota. That means the entire gray area we see here on the graph represents deadweight loss, a pure loss of overall surplus with no offsetting benefits for the government. So in a way, a quota can be seen as more inefficient than a tariff. It creates the same distortion in the market, harming consumers and reducing overall efficiency, but without generating any additional revenue for the government. Alright, let's shift gears a bit and talk about something we all do every day, making choices. But how do we actually make those choices, especially when it comes to what we buy and consume? That's where consumer choice theory comes in. Okay? The basic idea is that we all want to get the most satisfaction possible from our choices. Economists have a fancy word for the satisfaction. They call it utility. It's basically a measure of how much enjoyment or happiness we get from consuming something. Now let's look at this table. It shows how much utility someone gets from eating different numbers of pizza slices. The first column is pretty straightforward. It's just the number of slices. The second column shows the total utility, the overall satisfaction from eating that many slices. Okay? But the third column, this shows marginal utility. It tells us how much extra satisfaction you get from eating that one additional slice. Okay? Now check out this graph. See how that the utility increases as we eat more pizza. But then something interesting happens. It reaches a peak and starts to decline. Why is that? Well, it's because of something called the law of diminishing marginal utility. Essentially, it means that as we consume more and more of something, the extra satisfaction we get from that each additional unit starts to decrease. Think about it. That first slice of pizza after you've been starving is pure bliss, right? But by the time you get to the fourth or fifth slice, you might not be enjoying it quite as much. That's diminishing marginal utility in action. Understanding this principle can help us make better choices. It reminds us that sometimes less is more, and it helps explain why we don't just keep consuming one thing endlessly. Okay, we've talked about utility and that intriguing law of diminishing marginal utility. But how does this all translate into actual decisions? How do we figure out how much of something to consume to maximize our satisfaction? Well, let's revisit the concept of utility maximization. Remember, our goal is to get the most bang for our buck, or in this case, the most satisfaction for our pizza budget. Now this table has a new addition, the marginal cost. In our pizza example, it's simply the cost of each additional slice, which we'll assume here is a constant $1. Okay? Take a look at this graph. We have two lines here, one representing the marginal benefit, which is the same as our marginal utility, and the other representing the marginal cost. So how do we find that sweet spot of maximum satisfaction? The key principle is to keep consuming as long as the marginal benefit is greater than the marginal cost. In other words, keep eating pizza as long as that extra satisfaction you get from that next slice is greater than the dollar you have to pay for it. Alright, so we've mastered the art of maximizing utility with a single good, like our delicious pizza, right? But let's face it, life is rarely that simple, right? We usually have to choose between many different things, all vying for our attention and our limited budget. So let's add another dimension to our decision making. Take a look at this table. Now we're not just craving pizza anymore, we also want some refreshing cola to go with it. Okay? We still have our total utility and marginal utility for each good. But here's the challenge. How do we split our money between these two tempting options to get the most satisfaction overall? It's not as simple as just looking at the raw marginal utility numbers anymore, right? Why? Because as we all know, things don't always cost the same. Imagine a can of cola costs $2 while a slice of pizza is only $1. That changes things, doesn't it? We need a new strategy now. We have to think about the marginal utility per dollar spent. In other words, we need to compare the bang for our buck for each option. This leads us to a crucial question. How do we find that perfect balance where we squeeze the most satisfaction out of our limited budget, taking into account both the benefits and the costs of each good? That's the million-dollar question here, right? And we'll explore the answer in the next slide. Okay? All right. Let's bring it all together and see how this plays out in a real-world scenario. We've got our table with the marginal utility per dollar for both cola and pizza, but how do we actually make those consumption decisions? Well, it's like a treasure hunt for the most bang for our buck, right? We start with the item that gives us the highest marginal utility per dollar. In this case, it's that first slice of pizza offering a whopping 5 units of satisfaction for just $1. What a deal, right? So our first dollar goes to pizza. But what about the second dollar now? The first can of cola offers 7 units of satisfaction, but that's only 3.5 per dollar. Meanwhile, the second slice of pizza still offers 4 units of satisfaction, which is greater than 3.5. So pizza wins again. Our second dollar goes to the second slice of pizza. Now for our third dollar, the first can of cola finally takes the lead, right? It offers 3.5 units of satisfaction per dollar. That's higher than the 3 units offered by the third slice of pizza. But here's the catch. You can't just buy half a can of cola. So our third dollar and fourth dollar both have to go towards the first can of cola. Okay, and we can keep on going like this, always comparing the marginal utility per dollar for each option and prioritizing the one that gives us the most extra satisfaction for our money. Of course, our budget will eventually limit how much we can buy. But the principle always remains the same. Keep spending until you reach a point where you wouldn't gain any further net satisfaction from spending another dollar on either cola or pizza. That's our sweet spot, the utility maximization point. And there you have it. We've covered a ton of ground in this session. We've explored the ins and outs of elasticity, learned how different markets react to price changes, and delved into the impact of various government policies. And finally, we unlocked the secrets of consumer choice theory, figuring out how to make these spending decisions like a pro, right? But the journey doesn't end here. In our next session, we'll switch perspectives and step into the shoes of producers. We'll examine the production process, uncover the different types of costs they face, and see how these costs ultimately influence their output decisions. See you in the next session.